So my last video looked at a real-world example of a townhouse investment in Milton, where we looked at the cost of operating and owning a single-family home rental. If you haven't seen that video yet, I'll link it now. But if the owner were to sell today, he would be looking at $465,000 in profit. So naturally, the follow-up to that video would be to compare that investment with the exact same size investment in the stock market at the same time. I was a fairly new investor back then. I believed in ETFs because they were passive and they were diversified. I believed in dividend investing because who wouldn't want steady cash flow? I even found my old portfolio that I tracked on a spreadsheet. So we'll compare that as well. And that was a combination of ETFs and dividends and a little bit of tech investing as well. Just to keep this simple, I assumed a starting date of April 1st, 2013, because that's when the bulk of the payment for that townhouse was made. I didn't even talk about taxes because that's an entirely separate video. We'll start off with ETFs because ETFs are hugely popular. They require very little skill, they're passive, they are very diversified. Almost every financial advisor you talk to will recommend you diversify your ETFs. So we'll assume that we split this original investment of $126,500 evenly among the TSX, the S&P, the NASDAQ, and the Dow. Okay, so I head over to the trusty Yahoo Finance and I look up XIC, which tracks the TSX. I'll look up the charts and I'll maximize the charts and then try to scroll back to 2013, March or April, or as close to April 1st as I can get. And here it is, March 31st. 1947 was the price, so 2571 current price divided by 1947 times the balance that we would have purchased for, 31,625, and that gives us a price today of $41,760. So then I'll do the same for VSP, which tracks the S&P 500. I'll do the same now for the NASDAQ and the Dow, but I won't make you watch me do it. And here it is on the charts. I've added up all the totals so that you can follow along with me. Okay, so ETFs clearly did not match the return of the Milton townhouse. XQQ, that did great though. If you put 100% of your investment into that single ETF, you would be doing just as well. Okay, let's move on to dividend investing now. Let's assume again that we diversified our original $126,500 over the big banks available on TSX. And let's assume again that we reinvested the dividends so that we can increase the returns. So I found this really handy site. We'll look up our original balance, $25,300. We'll try TD first and we'll scroll back to March 31st, 2013. Hit calculate return, and there it is. That balance today would be $40,355. I'll do this again next with Bank of Nova Scotia, and I won't make you watch, but I'll add up CIBC, RBC, and BMO going through the same process. Okay, dividend investing didn't even come close. Personally, I'll probably never invest for dividends again until I'm old. Okay, let's move on to my actual portfolio that I had when I first started investing. But just full disclosure, I didn't start investing until 2014, so we'll have to backdate some of these, and not all of these investments were made at the same time. But I do honestly believe that this accurately reflects how I thought about investing back then. And if I actually had a large lump sum of money, real money, and I had to really invest in the market, this accurately reflects how I would have done that. So this is my actual portfolio from 2014. It had an ETF component, which represented 52% of the total portfolio. It had a dividend investing component, which was Enbridge, Royal Bank, and a dividend ETF that paid 7% dividends. And then I have some individually picked stocks, like Facebook, which did great. And then others went to zero, like DragonWave. I don't even remember what DragonWave did or was. And lastly, I have USO. I can't explain why I bought USO. I don't know. I I don't remember why I bought USO, but I certainly wouldn't buy it again. And it's not how I invest today. If I add up the sum of these investments, I get to just under $274,000. But I want to point out a few things that I'll highlight in yellow. These were my best performing stocks that were performing on par or better than the Milton Townhouse. The problem is they only represented 20% of my entire portfolio, and that's the problem with stock picking. You get some really big winners, and then you get some real duds. So clearly my own portfolio wouldn't have beaten the returns from the Milton Townhouse, but this was a really good exercise for me. I think it shows that the stock market can beat the returns on real estate, but it's only for the select handful of people who consistently pick big winners. And it's not enough to just pick the winners. You have to be able to ride the ups and the downs with the market. For example, Tesla, between 2013 and now, almost ran out of money countless times. Apple had a huge drop in 2019 and it had a huge drop in 2020 again. So you have to be disciplined enough to stick with it and not sell. And I guess the bottom line is that you can make a lot of money in real estate with less skill, but you can make even more money in the stock market if you can pick the huge winners and you can stay disciplined enough to not sell. Anyways, thanks for watching.